Hello everyone, thanks for checking out my video. There was a sell-off in the US stock market last Friday after a strong jobs report dampened Wall Street's hope for more interest rate cuts this year. For the longest time, investors have been trying to front-run the Fed on the number of interest rate cuts, but with inflation concerns resurfacing, it has been a wake-up call for them. Meanwhile, with three major indexes falling more than 1.5% last Friday and posted back-to-back weekly losses, the stock market gain that followed Trump's election win is close to being wiped out at the moment. Has the Trump bump become a Trump slump? We have lots of things to unpack in this video, including a stock that I bought last week, so do watch throughout to find out more. US stocks plunged last Friday as investors digested the final jobs report of 2024. The data blew past expectations as the US economy added 256,000 jobs in December, crushing the estimates of 155,000 jobs. The unemployment rate, which was projected to remain at 4.2%, dropped to 4.1%. When the report came out, stocks began to trade sharply lower. On the surface, this might not make any sense. I mean, why would a market tank if the job market is stronger and healthier than expected? Let me explain in simple terms. Such strength in the job market is definitely good news for workers looking for jobs. However, it could also sustain the upward pressure on inflation by keeping the overall economy running at a strong pace. That could in turn dissuade the Federal Reserve from cutting interest rates this year. Therefore, this jobs report is one of those classic good news is bad news type of data point. At the time of recording, many investors and financial institutions are revising their forecast for rate cuts this year. The market is now expecting a pause in January and March. Some are predicting the first cut of 2025 to only come in June. For Bank of America, they are even expecting a rate hike. The yield on the 10-year Treasury, which is correlated with rate expectations, spiked to 4.79% at one point, its highest level since November 2023. In case you don't know, high Treasury yield is bad news for the stock market as it makes bonds more appealing than the equity market. Together with high interest rate, it also increases borrowing costs, which can dampen companies' investment and expansion plans, thus affecting their profits. Last of all, investor sentiment was hit with another data that showed consumers are more pessimistic about future inflation pressures. According to a new reading from the University of Michigan's Consumer Sentiment Index, consumers are expecting inflation in the coming year to be 3.3%, up from last month's expectation of 2.8%. This is the highest reading in the survey since May 2024. Alright, strong jobs data is only part of the equation that affects the near-term market volatility. For the new week ahead, investors will get a fresh set of inflation data, the PPI and CPI numbers. PPI will be out on Tuesday, 14 January, while CPI will be released on Wednesday, 15 January. With concerns of inflation risk resurfacing, any hotter than expected read will give rise to a more hawkish Federal Reserve. Further signs of sticky or rising inflation may cause US dollar to surge and yields to go up again. This will come at the expense of the stock market performance. On another note, the new earnings season will kick off this coming week with reports from the major US banks and financial institutions, namely JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and Wells Fargo. Investors will be closely monitoring how the higher for longer interest rate environment may affect the financial sector as well as the broader US economy. Okay, let's now read some charts. As always, we shall begin things off with SPY. SPY's chart looks straightforward to me, which means the broader market's movement will be pretty clear-cut too. But just a quick note, straightforward and clear-cut doesn't mean I know where the market is headed next. What I mean is, the key levels that determine the next direction is straightforward. So, SPY is currently at a pivotal point. If there is only one level to watch, this level is 581. But of course you can give and take a little bit, +1 or -1. Alright, why this level? If you had followed my last two videos, you will know about this bearish head and shoulder pattern. It might not look like the most textbook version kind of head and shoulder, but this is the real market. It will not give you the exact or perfect setup. Anyway, 581 is where the neckline is. In the head and shoulder pattern, the neckline is the most important level to watch. Once it breaks, it's likely a waterfall, which means we could have a huge downside, probably towards the 560s range. But that said, even if the market is bearish, going to 560s range takes time. It will not happen in just one day. It can take a few days or weeks. In short, once we are below 581, the market trend is bearish. Be very careful if you are holding on to bullish trades or options. Here are further reasons why this 581 is one huge key level to watch. As you can see from the chart, it is a level that the bulls used to have some difficulty breaking above previously. Once it got above, it became a level which the bears experienced difficulty to break below. This simply shows how pivotal this level is. Well, SPY did try to go below last Friday but managed to recover and close at 580-581 level. Like I said, give and take a little bit, alright? Speaking of last Friday, SPY filled a portion of that gap. Come this week, if SPY couldn't hold this 581 level, I would expect SPY to fill the gap entirely because the bears are already knocking on the door. On the other hand, if SPY starts to close above 581 for at least 2 days, then we can take a little breather, because that would mean bulls are defending this important support level pretty well. But for SPY to resume or regain some bullish momentum, it needs to at least reclaim the 50 moving average at around 592. Moving over to Apple. I think around 1 or 2 months ago, I shared that given this parabolic run by Apple, the share price will eventually pull back significantly simply because such euphoria is not sustainable. Well, Apple has dropped about 8% since it hit a record high of 260, erasing more than $300 billion in market cap. That's like wiping out the entire Coca-Cola company or Disney. Very similar to SPY, Apple is currently sitting at a pivotal level or area. This again makes the technical analysis straightforward. Let's give this area a range, which is between 235 to 237. This area is made up of two important levels, the critical 61.8 Fibonacci retracement level as well as the blue line that I drew. So where did the blue line come from? If I zoom out the chart, you will be able to see that this level used to be a resistance level where the bulls had difficulty breaking above. But once it broke above, it did not look back for a while. The same can be said for the downside. If Apple starts breaking below and closing below this 235 to 237 area, the downside potential could be massive as well. We could be looking at 220s range again. From there, don't be caught off guard if it continues to slide towards 219 or slightly below it, because that is the bottom area of this consolidation zone. In terms of the upside, again you can use the 235 to 237 area as a gauge. A solid close above this area for at least 2 days would mean that Apple is stopping its rot for the time being. But if we want to be more convinced that the bulls have slightly upper hand, then very minimally it should reclaim the 50 moving average at around 239. Overall, Apple and SPY movements look pretty similar at the moment. This is why a lot of people say that Apple is a market moving stock. Though recently Apple has been fighting with Nvidia for being the most valuable US company, it seems like when Apple sneezes, the broader market may still catch a cold. By the way, I stepped in to execute an options trade on Apple last week. More on that later in the options segment. Okay, moving over to Tesla's chart. Tesla has been moving within this nice little downtrend channel. In terms of price action, it has been making lower highs. This means Tesla is bearish in the near term. We have two big events coming up for Tesla, namely Trump's back in office on 20th January and also Tesla's very own earnings result on 29 January. Both events can potentially make or break Tesla's share price, so be very careful if you are trading Tesla this month. Going back to the chart, so long as Tesla continues to move within this downtrend channel, then it is bearish. In terms of support levels within the channel, watch for 383 and 350. Last week, Tesla's either went near or tested the first support level of 383 on a few occasions, but so far, the bulls had managed to bring the price back up when the session closed. In short, Tesla did not close below this level last week. My thesis is still the same as my past two videos. If Tesla starts closing below this 383 level for 2 days or so, we could very likely see Tesla in the 350s range before we all know it. At 350 or below 350 where the bottom channel is, Tesla has to bounce. Otherwise, it's even more bearish than it already is. By falling below the downtrend channel, or worse still, breach that critical 61.8 Fibonacci level, don't be surprised if you start seeing Tesla at that green support zone that I drew. That's 270s range at least. Okay, I don't want to scare anyone right now. Watch how Tesla moves within the downtrend channel first, alright? In terms of the upside, hold on, give me 30 seconds. If you found my content useful so far, and if you are looking for a new brokerage account and would like to support this channel, do consider using my referral link to sign up for this brokerage called Longbridge. Quick disclaimer, do your own research first before signing up, and I got to be transparent, I do get rewards when you sign up using my link. The welcome promo is as shown on the screen. You can pause the video or check out the link in the description box below, as I don't want to take up too much of your time right now. Okay, back to business. For the bullish thesis, so long as Tesla holds above the 383 support level, the situation isn't that bad. Because the longer we hold above this level, it means very soon Tesla will be outside and above this downtrend channel. But then, for Tesla to be out of the woods or regain its bullish momentum, it needs to reclaim the 23.6 Fibonacci level at around 423. A few solid green candles above this level could give us high probability of testing the record high in the 480s range. And oh, just one more thing, since Tesla went on this parabolic run, it hasn't tested the 50 moving average. I'll be quite curious how the share price will react when it touches the moving average. Sometimes market makers or big institutions might set some algorithms such that when certain moving averages get breached, the system will automatically dump some shares. Not very sure about this, just my speculation, but let's see how the share price reacts. Let's now move over to Google's chart. Google appears to be in a consolidation stage as the share price has been moving between 187 and 201. We actually touched the 201 level twice, and on both occasions it didn't manage to close above it. This means whenever the bulls brought the share price above 200 during intraday, sellers step in to push the share price down. Therefore, for a breakout in the share price, Google needs to close above 200 at least, and not just an intraday peekaboo kind of movement. Anyway, getting rejected at 200 and 201 has somehow created a potential bearish double top pattern. The neckline is at around 187, which coincides with this bottom of the consolidation zone. In other words, watch this 187 like a hawk. The share price went near this level on a few occasions, but the bears couldn't bring it below. Which also means if Google starts closing below 187, it spells trouble, at least in the short term. We could be headed towards 182 where the next meaningful support is. Maybe if you wish, you can stretch it to the 50 moving average at around 181. If Google doesn't bounce from 181 to 182 area, then the big gap between 176 to 181 could act as a magnet to pull the share price towards it. That's when we will likely see Google hitting 170s range again, a range that we have not seen since that huge gap up on 10 December. That was the day when the company announced a new quantum computing chip called Willow. Alright, we will now move on to Meta. I know I mentioned about a potential bearish inverse cup and handle pattern in my previous videos, but with Meta going as high as 632 last week, it has somehow invalidated the pattern, so let's move on from that. At the moment, there is nothing significant or crazy in terms of its price action. In terms of the downside, we can perhaps pay attention to two support levels, 604 and 584. For 604, Meta has flirted with this level for the entire last week as shown by the wicks. But for each and every day, the bulls always manage to bring the share price back above this level when the market closes. So, if this level gets breached this week, it could be a sign that the bulls are losing strength. Then comes 584, that's the other level that Bears tried to break below recently but failed to do so. Once again, if Meta starts closing below it, that's bearish, and with two decent support levels broken, I am of the view that there is a decent probability for Meta to drop towards 550 where the important Fibonacci level is. That's also roughly the top channel of this blue downtrend channel. On the other hand, if we get a bounce from either of the support levels, 604 and 584, that's slightly bullish. Meta could then hit towards 630's range again. And if it breaks above the 638 record high, then it's obviously bullish, and I think sellers may dry up temporarily. Next up, let's have a look at Microsoft. As shared in the last two videos, this potential bearish inverse cup and handle pattern is not quite there yet, as we only have the cup pattern without the handle. So I will chuck this pattern aside for now unless the handle starts forming. Okay, but I have added a new blue downtrend line. At the moment, Microsoft does still look bearish for a number of reasons. First of all, it fell below the green uptrend line after going up briefly. Second, it has been creating lower highs since mid-December, marked by the blue downtrend line. Thirdly, it failed to reclaim the important area that is made up of the green dotted line, the 50, 100 and 200 moving averages, as well as the 61.8 Fibonacci level. The range of this area is between 424 and 427. Okay, for sharp viewers, you might notice this range differs from what I mentioned in my last video. The reason is because the moving averages are dynamic and the green trend line is going upwards. Okay, once we have identified this important range, then it's straightforward. For Microsoft to be bullish, it has to punch above this 424 to 427 area. For bullish confirmation, it needs to reclaim 436 at least and fill that little gap. On the other hand, as long as Microsoft stays below 424, it is still bearish and may continue to create new lower highs along that blue downtrend line. Let's now jump over to Nvidia. Nvidia looks very interesting to me. I think it's pretty on par with Tesla in terms of volatility. I mean, look at that huge gap up, followed by a huge gigantic red candlestick. The funny thing is, on that day when Nvidia printed the big red candle, it also hit an all-time high at 153, and yet the share price fell 6% on that day. Okay, but if you take a step back, there's nothing too alarming except for it being very volatile. I have shared in my last video that when the stock breaks out from that red downtrend channel, there is a chance that it might retrace to retest the channel, and it is doing that right now. In case you ask, will the share price rebound off that channel? Sorry, I don't have that answer. I always like to say this: why guess the next movement? Let the market makers go first, let them show you the next direction, and you follow after. Which means if it rebounds off the downtrend channel, then it is bullish. But that said, watch for a few key resistance levels because it could be a fake rebound. Just like playing a game, there are a few levels that Nvidia needs to clear before it goes to the big boss level, which is all-time high. The first safe room or level is 137, where the important 61.8 Fibonacci level is. By closing above it, that's a positive sign. In my opinion, Nvidia needs to at least close above 140. Then, I dare say there is some possibility of resumption of bullish momentum, because 140 is a double resistance level formed by the 50% Fibonacci level and the 50 moving average. Going above it is definitely something that the bulls can cheer about. On the other hand, if Nvidia continues to trade below 137 resistance level and will still get back into the downtrend channel, then the bulls might want to be on alert. We could visit the recent low of 126 again. In fact, if we hit 126, I am of the view that it might not end there, because the bottom of the channel is around 116 to 119. In other words, there is still room for the share price to fall. At this area, watch out for the 200 moving average, which currently sits at 119. If this moving average breaks, it's waterfall time. Moving over to the options trading section, one trade to update this week, which is this new cash secure put on Apple. The contract was sold last Friday 10 January with a strike price of $2.15. The expiration date is 21st February. There were a few reasons why I stepped in to make this trade. First of all, last Friday was a bloodbath in the market, as the entire market reacted negatively to a hot jobs report. On that day, Apple got sold off like many other stocks and was hitting the oversold level on the RSI. The last 3 times when Apple's RSI reached or went near this level, it rebounded shortly after, and the share price was higher about 1 month later. On top of this, the sell-off has also brought Apple to a decent support level formed by the blue support line and 61.8 Fibonacci level at around 235 to 237. With an oversold RSI and a decent support zone, I was of the view that there is a decent probability that Apple might see a short-term rebound or go sideways. Next, due to the sell-off in the market, VIX, the volatility index, has spiked up 8%, and the IV of this contract that I sold went up as well at around 30%. For context, I sold 3 put contracts on Apple last year, and each time the IV was below 30%. Therefore, I must say it's a little rare to see Apple's options having an IV of 30% or more. In case you don't know, high IV means high premium, and it benefits option sellers like me. All that said, I could be totally wrong. Apple could break below the decent support area and continue to flush further down. To manage my risk, I chose a strike price that is below a few more support levels. Those levels are the 100 moving average, the recent low of 219, as well as the strong 200 moving average. If you were to zoom out the chart, you can see that since Apple embarked on this monster bull run, it has not gone below the 200 moving average. Furthermore, 200 moving average has always been a strong dynamic support level. But let's say if all else fails and Apple decides to go below 215, wow, that would be quite significant, because for Apple to drop from its recent high of 260 to my strike price of 215, that's a 17% drop, and Apple would have lost more than $650 billion in market cap. That's very close to a crash already, which is defined as a 20% plunge from the peak. If this happens to Apple, I would think there is a likelihood that the overall market is in a pretty bearish state. Almost all stocks would be affected. If that's the case, I have nothing to say, because no one would have been able to predict a correction or crash accurately. From there, my backup plan would be to either take assignment or roll my contract. But of course, I can also choose to close my position early. As you can see, within half a day of selling the contract, it is up by about 13% already. So yep, it's all about managing the risk. Okay, sharing some thoughts on the current situation. In the last 2 months, stocks have surged to record highs following Trump's victory, as investors cheered on the possibility of tax cuts and deregulation, which are considered favorable or tailwinds to companies. But right now, the focus has shifted back to inflation and the path of interest rates for 2025. The recent economic data has poured cold water on Trump's rally, as the market has given up almost all the gains it had gotten since the election. In fact, from the post-election day surge till last Friday, the S&P 500 is actually down more than 1.5%. This is not surprising, because euphoria that came out of nowhere will eventually take a break. Personally, I think the problem lies with the Wall Street sending US market to a series of record highs in 2024 on the basis that there will be a stream of rate cuts coming from the Fed this year. In short, the market was trying to front-run the Fed. At one point last year, the market was anticipating about 4 rate cuts to happen in 2025. Then in December, the expectation got scaled back after the latest Fed's dot plot plan shows that the central bank is likely to cut interest rates only twice this year. Right now, the market is even more divided. Most expect these 2 rate cuts to be pushed back to second half of the year, while some anticipate 1 rate cut, and worse still, we have people even preparing for a rate hike. Interestingly, during December's post-FOMC meeting press conference, Fed Chairman Jerome Powell was asked by reporters if he could rule out potential rate hikes in 2025. He responded by saying, "You don't rule things completely in or out in this world," though he went on to mention that doesn't appear to be a likely outcome. Well, never say never. Now with a hotter than expected labor market and inflation potentially back on the rise, who knows, Powell's stance could change. Remember, he once said that inflation was transitory, but inflation went up to as high as 9% at one point. Okay, I'm not saying Powell isn't great. In fact, most of us probably can't do a better job than him. I'm trying to say that nobody can predict the future. Not Powell, not Trump, not you and I. So what we can do now is to stay nimble and flexible. Okay, I digressed. All in all, sometimes the market is their own worst enemy when it comes to policy moves by the Fed. The market tried to front-run the Fed on their monetary policies, and it seems like we are now paying or about to pay the price. The recent market movement is a wake-up call for many, especially those who are too complacent or took on too much risk. Anyway, in short, if fewer cuts materialize than expected, stock prices would likely either need to fall or profits of the companies would have to rise more strongly to make up for it. Smaller and high-growth companies will likely experience a bigger drawdown when the interest rates remain elevated due to their need to borrow money to grow. The Russell 2000 index of smaller stocks has already slumped 2.3% year to date, and I wouldn't be surprised if it drops further this year if interest rates remain high throughout. As for the mega cap companies, they may not be spared as well. Investors in the futures options market are betting the US 10-year Treasury yield to hit 5% in the near term. This 5%, if hit, could be bad news for US stocks in general. Just like back in October 2023, when the 10-year yield jumped to 5.02%, it coincided with the S&P 500 dropping to a 5-month low. As I have previously shared, this month is going to be more volatile than last month. We have already seen how the market reacted to the latest jobs data. Coming up, we have the CPI inflation data, Trump taking office, yield potentially hitting 5%, earnings season, and FOMC meeting. So be mentally prepared to see whipsaw movements and huge swings in the indexes, and especially so for individual stocks. That said, as always, I may sound like a broken recorder, but I still want to say this. Any form of pullbacks present opportunity to buy shares of good companies at discounted price. So last week I dipped my toes in and bought a few shares of Microsoft, and I will continue to watch the market very closely in the next 4 weeks with my shopping list beside me, hoping to add more shares to my long-term portfolio. Okay, disclaimer, that's my own plan and definitely not a financial advice for you. It has worked quite well for me in the past 1 to 2 years, which I have covered in this video on the left where I reviewed my stock portfolio performance. Do check it out if you haven't, and don't forget to like this video before you exit, alright? Thank you.